Good morning, everyone, and welcome to The Morning Bell. I'm Robert, and it's Wednesday, January 28th, 2026. Joining me, as always, are Lizzie, our energetic trader with her finger on the pulse of the markets, and Steve, our data expert who keeps us grounded in the numbers. Well, what a week it's shaping up to be. Lizzie, we've got some fascinating dynamics playing out in the markets right now. The Nasdaq is eyeing a record high. We've got major tech earnings rolling in from Meta, Microsoft, and Tesla. And then there's this incredible move in gold hitting above $5,300. What's your take on what's driving these markets right now?
Robert, it's absolutely electric out there. The tech sector is really leading the charge here, and I think what we're seeing is this perfect storm of strong earnings expectations, combined with a weakening dollar that's making everything pop. The Nasdaq pushing for new records tells us that despite all the macro concerns we've had, big tech is still delivering. Meta, Microsoft and Tesla reporting this week are going to be critical because they set the tone for the entire tech sector valuation. But here's what's really catching my attention. That gold move above 5,300 is not just a random spike. We're seeing a fundamental shift where gold is becoming the safe haven of choice, especially with Trump's recent comments about the dollar causing it to tumble. Traders are hedging their equity positions with gold, and there's this new force in the gold market that Bloomberg mentioned, which I think is central banks diversifying away from dollar reserves. The correlation between a weaker dollar and stronger gold is textbook right now, and it's creating some really interesting trading opportunities across multiple asset classes.
That's a great point about the dollar weakness being the common thread here. And speaking of job markets, we're seeing headlines about the top 10 jobs in 2026, all paying over $100,000, mostly concentrated in a single industry. This speaks to the structural changes happening in the economy, doesn't it?
Absolutely, and this is where the equity story gets even more interesting. When you see that kind of wage concentration in specific industries, likely tech, healthcare and finance, it tells you where the economic power is consolidating. For traders, this means those sectors continue to have pricing power and strong fundamentals. The other big story I'm watching is Amazon laying off 16,000 corporate workers in their anti-bureaucracy push. Now, initially that sounds negative, but the market's actually viewing this positively because it signals efficiency improvements and margin expansion. We saw chip stocks rally after Nvidia got that game-changing China approval, and that's adding fuel to the tech fire. The market is clearly differentiating between companies that are optimizing for profitability versus those just chasing growth at any cost.
Excellent analysis. Steve, let's get into the economic data because we've got some critical numbers to discuss. What did we see earlier this week? And more importantly, what's coming up that traders need to watch?
Thanks, Robert. Earlier this week on Sunday, January 26th, we got the durable goods orders report, and it came in significantly stronger than expected at 5.3%, versus the forecast of 3.7% and the previous reading of 2.1%. This was a really impressive beat that shows manufacturing demand remains robust, which supports the broader economic growth narrative. Now, looking at today, Wednesday, January 28th, we don't have any major economic indicators scheduled for release, but that doesn't mean it's a quiet day by any means. Later today, we're getting the federal funds rate decision from the Fed, and this is the big one with very high volatility impact. The market is expecting rates to hold steady at 3.75%, matching the previous level, so the focus will really be on Fed Chair Powell's commentary and the forward guidance. Looking ahead to tomorrow, Thursday, January 29th, we'll get initial jobless claims, which gives us a fresh read on labor market health, along with the trade balance report, where forecasts are calling for a deficit of $40.5 billion, compared to the previous $29.4 billion. We're also getting factory orders tomorrow with expectations of 1.6% growth. Then wrapping up the week on Friday, January 30th, the Producer Price Index comes out, which is a critical inflation indicator. The forecast is for 0.2%, matching the previous reading, and this will be closely watched because it feeds into the Fed's inflation assessment and could influence their future policy decisions.
Thanks, Steve. That Fed decision today is definitely the elephant in the room. Now, Lizzie, let's shift gears to something our listeners always love: value stock opportunities. You've been analyzing some compelling value plays. Walk us through your top 3 picks and what makes them attractive right now.
I'm really excited about these 3 names, Robert, because they represent genuine value in a market that's gotten pretty expensive in many sectors. Let's start with my number 1 pick, Allstate Corporation, ticker symbol ALL. This insurance giant is trading at a price-to-earnings ratio of just 6.29, which is incredibly cheap for a company with such strong fundamentals. The price-to-book ratio is 1.99, which is reasonable for the financial sector. But here's where it gets really interesting. Allstate has a return on equity of 34.5%, which is exceptional, and shows management is generating strong returns on shareholder capital. The dividend yield is absolutely massive at 204%, and the P/E ratio of 0.03 suggests this stock is significantly undervalued relative to its growth prospects. With a profit margin of 12.5% and a market cap of $51 billion, this is a stable, profitable company that the market is mispricing. The debt-to-equity ratio of 29.43 is manageable for an insurance company, and I think the market is overlooking the strength in their property and casualty business.
That dividend yield is remarkable. What about your second pick?
My number 2 is Globe Life, ticker GL, another insurance play, but with a different profile. Globe Life is trading at a PE ratio of 9.98 with a forward PE of 9.15, so we're getting growth at a reasonable price here. The price to book is 1.94, and the return on equity is 22.3%, which is still very strong. The dividend yield is 78%, which is substantial, and the PEG ratio of 0.27 indicates the stock is undervalued. What I really like about Globe Life is their profit margin of 19.4%, which is higher than Allstate, showing they run a very efficient operation. The market cap is $11.14 billion, so it's a mid-cap play with room to grow. The debt-to-equity of 55.22 is higher than Allstate, but still manageable given their consistent cash flows. Globe Life specialises in life insurance and supplemental health, and they've got a direct-to-consumer model that's been very effective. At $137 per share, I think there's significant upside potential here, as the market recognises their operational excellence.
Both insurance plays, which makes sense given the sector's been overlooked. What's your third pick?
Rounding out my top 3 is the Mosaic Company, ticker EMOS, which takes us into the agricultural and fertiliser space. This is trading at a PE of 7.37 with a forward PE of 11.29, and here's the kicker, the price-to-book ratio is 0.71, which means you're buying this company for less than its book value. That's classic value investing right there. The return on equity is 10.1%, which is lower than my other 2 picks, but still respectable, especially in the cyclical fertiliser industry. The dividend yield is 311%, which is extraordinary, and the PEG ratio of 0.03 shows massive undervaluation. Mosaic has a profit margin of 10.3% and a market cap of $9 billion. The debt-to-equity of 37.13 is reasonable. What makes Mosaic compelling right now is that fertiliser prices have been depressed, but global food demand isn't going away. And we're seeing signs of agricultural commodity prices stabilising. At $28.44 per share, this is a contrarian play on agricultural recovery, and I think patient investors will be rewarded as the cycle turns.
Those are 3 really solid value picks across different sectors. Now let's talk crypto because there's been some interesting movement. What are you seeing in Bitcoin, Ethereum, and Solana for the week ahead?
The crypto space is showing some really bullish signals, Robert. Bitcoin is sitting just below $90,000 and we've got $10.8 billion in Bitcoin options expiring this week, which could create volatility but also potentially push prices toward $95,000 if bulls maintain control. The sentiment is definitely bullish, driven by several factors. First, the dollar weakness we talked about earlier is a huge tailwind for Bitcoin. Second, we're seeing public companies like Steak and Shake adding $5 million to their Bitcoin reserves, which shows continued institutional adoption. There's also talk of a Bitcoin ETF break-even level at 86,000, and with US wirehouses reportedly getting more involved, the institutional infrastructure is strengthening. The key thing to watch is today's FOMC meeting because Fed policy still impacts crypto sentiment. For Ethereum, we're looking at a potential rally to $3,300, and there's exciting news about a trustless AI agent standard hitting the Ethereum mainnet this week, which could be a significant technological advancement. The metrics are pointing bullish despite some broader crypto market weakness. Solana is following the general market trend higher, benefiting from the weaker dollar and improved risk appetite. The overall positioning shows institutional money continuing to flow in, while retail remains cautiously optimistic. The main risk factor is any hawkish surprise from the Fed today, but assuming they hold steady as expected, I think we see continued upside across all 3 major cryptos into next week.
Fantastic overview, Lizzie. So to wrap up, we've got a market that's pushing higher on strong tech earnings, a Fed decision later today that everyone's watching, some compelling value opportunities in insurance and agriculture, and a crypto market that's showing bullish momentum on dollar weakness. It's certainly an exciting time to be watching these markets. Before we go, I want to remind all our listeners, remember, do your own research and consult with financial advisors before making investment decisions. The analysis we provide here is for educational and informational purposes. Thanks for tuning in to The Morning Bell. I'm Robert, and we'll see you tomorrow with more market insights. Stay sharp out there.